Good morning, everyone, and welcome to the True Potential Do More With Your Money podcast. This is number 50 of the series, and it's the first of 2021. Today, I'm joined by George Bell, investment analyst. Morning, George.
Mark. Good morning.
Chris Leyland. I'm very well, thank you, George. Chris Leyland, Director of Investment Strategy, and Jeff Casson, Chief Investment Officer. And before we get into details of what happened last year in the market and what we see things happening this year, I just want to ask the three gentlemen if they got up to anything mischievous or interesting over Christmas and New Year. And start with the most mischievous of them all, George.
So this year, a little bit quieter than normal, Mark. I think the last 2 years I've been in Mallorca for Christmas, so I've actually been in the sea on Christmas Day and New Year's Day. I went for a run up on the coast in Northumberland on Christmas Eve and on New Year's Day, and there was people swimming in the sea on both days then, but I wasn't brave enough for that. But yeah, quite a nice relaxing Christmas time, less travel, which is quite nice as well. But yeah, a few less boozy headaches over the Christmas period where you're normally catching up with friends. But I think, Mark, you might have seen a video of me having a shot of whiskey on New Year's Eve. I'm not a whiskey drinker for the audience, so there was a few funny faces pulled, and I hope that's not a New Year tradition for the team.
George, I did see the video, and it wasn't a shot. It was about half a pint of whiskey that went down in one go.
Like I say, I'm not a whiskey drinker or a whiskey pourer, I don't think.
No. And Jeff, what about yourself up in Scotland?
Yeah, we had a good time with the family, so the boys really enjoyed the Christmas period. And over the past couple of years, when we've been travelling back and forth to Northern Ireland, the New Year, I've went for a dip in the sea and up at the north coast. So this year, obviously, we couldn't travel, so went down to the river and had a dip in the river on New Year's Day. Rather chilly, but like George, I used a little bit of whiskey to warm myself up after that.
Chris, I mean, did you go for a dip in the Thames or in the Serpentine?
Yeah, no. I definitely didn't go for any dips in any river at all. It was a bit different for me this year, actually. So normally, myself and my girlfriend, Maura, we spend some time with my family and some time with her family. So my family's in Liverpool, her family's in Edinburgh. And we originally booked to go to Edinburgh. But then obviously as it got closer and closer to Christmas, Boris came out and said that, London's tier 4, you can't travel. So it was actually the first Christmas that me and Moira had spent just the two of us. So we frantically went round trying to buy a turkey, which is more difficult than what we thought it would be because everywhere had sold out. And we actually had a really, really nice day. So I cooked all the vegetables. She cooked the turkey. Meal was fantastic. And I just had a nice day. And other than that, I think, just echoing what George said, been pretty quiet, but nice. You just get used to a sort of slower pace of life, going for a nice walk, cooking a bit of food, relaxing. So for me, yeah, it was really positive.
So the Christmas lunch was cooked from scratch, was it, Chris?
The joke here is that I once said that I cooked lasagna from scratch, but I didn't make the pasta, which was obviously really disappointing for everyone. But I can say, other than kind of plucking the turkey or anything like that, it was made completely from scratch. No Aunt Bessie's potatoes or anything. Everything was properly done. So very, very pleased. I should have taken a picture for everyone, actually. If I actually have got a picture. I'm thinking about it. I have got a picture, so at some point, if anyone wants to see it, let me know.
Well, we'll ask Graham to put it into the final version of the podcast, Chris, so everybody can see.
Absolutely, yeah.
Okay. Now, you said that it's been a bit of a slower time between Christmas and New Year, but certainly it wasn't a slow 2020 for anybody working in financial services and investment management. And Chris, before we get into 2021, would you mind just bringing us up to date with how the portfolios performed in 2020, please?
Yeah, absolutely. No, I think you're exactly right in the sense that 2020 arguably was a roller coaster ride. The reality is I think about my career in fund management. I started in year 2000, but I've certainly never seen equity markets sell off as quickly as they did in February and March, and then I've never seen them recover as quickly as they did throughout the rest of the year. When we look at the true potential portfolio proposition, I'm really pleased to say that we showed positive returns. So, for example, if we look at the balanced portfolio, which is our most popular portfolio, that was up just over 3.5% over the year. And when you think about actually what happened in 2020, for me, that's a good result. So overall, what you saw is basically just markets continue to recover. Whether that be after the initial sell-off, whether that be from the vaccine or the vaccines even that we saw coming through November, we're still seeing coming through now. And for me, it leads into quite a positive outlook for 2021, which I know we're going to talk about a little bit later on.
Yeah, and 2021 has begun with some news flow, we could say. A characteristically undignified end to the Trump administration, Jeff, I think it's fair to say. And what was nice and refreshing from my point of view is I watched this on the news, and then your morning briefing, you cut right through all of the drama that was happening there. And we just do, as we have to, we're impartial about these things. We've got to interpret what's happening in the news and what's happening in the markets. But it's important that we do cut through the rhetoric and just concentrate on what's best for our clients, our investors in the portfolios. So with that in mind, that scene setting, we can't ignore what happened on Capitol Hill. But what are your thoughts on it, Jeff, and how markets reacted?
Yeah, it's one of those things where as a team, we have our morning meetings and we focus in on what's happened overnight, but we have to then, as you rightly say, Mark, get it back to what does it mean for the true potential portfolios, what does it mean for how we're positioned, and what does it mean for our end clients ultimately. I think, if we take a little bit of a step back and we think about just even the past 2 weeks, the run up to Christmas Eve with the Brexit agreement, and then we move into the second into January, and we start with the runoff for Georgia, and political risk there evident, something that we talked about all the way through last year as being an important driver for markets. So we can effectively, I suppose, tick off that's Brexit kind of behind us, in the sense that we do have that agreement there. Trade sorted out, services to continue to be negotiated. And if anybody does want more detail around that, I'd really encourage them to look at the note that we put out last week, which gives you a real good indication of just how that agreement plays out and what it means for different parts of the economy. I think then looking into just what we've seen this week and thinking about the runoff in Georgia, about 68 weeks ago, it didn't look like we would have a Democratic victory there, i.e. that we would have the Democrats taking both seats. And as we've touched on, that has been really crucial for President-elect Biden to be able to push through some of his agenda. And that's what really the market has started to focus in on this week. And we did see that come through in various different asset classes. And I think probably most evident is what we have seen in the US Treasury market. And if we look at where yields were at the start of the year, about 0.9%, we've now moved all the way to 1.09 at the close last night. That's quite a significant move in the US 10-year. But if we think about why is that happening, what are market participants potentially thinking about? They're thinking about more fiscal support coming through in the US. That more fiscal support should be positive for growth, positive for the outlook for 2021. Yields are moving out because there's a view that maybe inflation's going to pick up. But what do we know? We know that the Fed, whilst they will focus on inflation, that's only one part of their mandate. They'll focus on getting average inflation to 2% over time, but letting it run maybe slightly ahead of that. But the other key aspect that they've been really reiterating over the past number of months post that review is employment. And that is the avenue that we still need to see picking up in the US. We get the non-farm payrolls number today. We'll see what that brings, but it's not going to show a tremendous change. The employment situation is the one aspect that really does need to come through, and that is something that for 2021, as we see growth pick up, we then need to see employment pick up, both in the US but also globally. I think just maybe another couple of points just to throw into that. There's, as Chris has alluded to there, we've got vaccines. We've got various different vaccines now. What have we seen over the past week? We've seen very different rollout agendas and how that's going to be targeted across different countries. Again, that's going to be crucial to getting things opening up again and things returning to normal. Maybe us not having to do all of these remotely. We'll maybe be lucky enough at some point this year to get into the office and do it round the table, which would be a great way to bring it back to the reality of, we're all doing things differently. And then the other point just to bring out is just lockdown measures. Again, the start of this week, the UK moves into different positions, albeit we've got various different dynamics in each of the countries, be it Scotland, England, Wales or Northern Ireland. But that's the same as happening in Germany. We've just seen overnight Tokyo announce some additional lockdown measures. So again, there will be bumps on the road as we navigate our way through this. But it's been a fascinating week already, and it's just been the first week of 2021. And I suppose that's the beauty of asset markets and what we do, that we get the chance and the opportunity to look at all of these dynamics, crucially think about how we position portfolios for them, and to deliver over the longer term for our clients, taking account of just, yes, there's things that are happening, but how does that influence the longer term view that we've got?
I think that's a really interesting point. Sorry, Mark, I was just going to say it's an interesting point you pick up about the market reaction in response to the expectation that more fiscal stimulus will come through. And if we think back just a couple of weeks in terms of where that anticipation came from, you had the $900 billion package, which was agreed in principle with the expectation that it would just go to the White House and get the stamp of approval, but wasn't so straightforward. So in terms of what that's now looking like, well, Trump's issue with the package was that the checks to individuals was too low, which is ironic because it's $600, which was negotiated by the Republicans, was much lower than what the Democrats initially wanted. So he was talking about $2,000 checks, which has now really became the flashpoint. And as you say, that has been priced into what we're seeing within the bond markets. You've seen yields start to back out there as greater supply of bonds will be issued in order to finance a lot of the government spending. The more issuance of bonds, price comes in, the yield pops up on that side. But we've started to see the expectations of more fiscal spending feeding into greater expectations for economic growth. So if we look at the US, the Fed was suggesting that growth into next year could be around 4%. I've seen on Bloomberg expectations of that creeping up slightly higher now. So it's starting to really feed through into terms of what this could mean with Democrats on side. And in terms of that spending, I mentioned there the support package, which is really a pandemic support package to help individuals and small business, but it's also fiscal or government spending on areas such as infrastructure and energy. And I think that's going to be a really interesting topic as we roll through 2021. It was one of the key divergences between the Trump administration and the Biden administration in the run-up to the election. Trump was very much, supportive of the advancements which the US have made in terms of becoming more self-sufficient in the energy market. We've seen rapid, increases in output in terms of shale energy, in terms of their use of gas in their own production of oil, which has really reduced the net imports of oil. They've become a lot more self-sustainable. But what's been interesting is, whereas you've seen around and I put a note out about this back in October, around a 25% increase in natural gas in crude oil output in the US, you've only seen around a 10% increase in renewable energies. Renewable energies really being a focal point of Biden's administration and how he intends to evolve that space over the coming years. And that in itself, spending in infrastructure, it can have a lot of benefits. No doubt a number of jobs will have been lost permanently from the pandemic. The world has evolved. So the infrastructure investment could pick up a lot of that job market slack, which has been created in this environment. And I think the other point was just in terms of, the executive order on a number of the technology firms in China, so the telecom and the tech app providers there, which Trump wasn't going to go out without a bang. I think this was perhaps his final punch at China, but it's created a bit of confusion with the New York Stock Exchange not knowing what's best to do in terms of whether they do delist or what the exact terms of the executive order are. I think now it's pretty much looking as though that's in the hands of Joe Biden, given the time in which that could take to come to effect. So there's an additional present for the Biden administration for his first day in office, where he can decide essentially the direction in which he's going to take that. But how much are markets paying attention to that? Well, it did have an impact on the Hang Seng on the day. It had an impact on a number of those names in there. But we've got to take into consideration the fact that Trump did concede last night, not in his own words by any means, quite the opposite, but in effect he did concede to Joe Biden taking control of the White House last night. And you've already got pressure for a Section 25 to get Trump out before the 20th. And a number of his administration has left. So what's the message there? Well, perhaps markets have got the ability to really focus on the fact that there is going to be a change of hands in political leadership there. We know that date is coming, and we could be in for a bit of a calmer scene on the political front. But in that, Joe Biden's no free market trader. He has shared one commonality with Trump, and that is the need to be a bit tougher on China. So he may use this entry point, this is just my opinion, he may use that as an entry point to give him a bit of leverage in his negotiation to, there's Trump's starting point. This is where we'll get to, and in the meantime, agree better terms. But yeah, fascinating start to the year.
Yeah, it's an interesting one, George, because I looked at that as being a bit of a poison pill that Trump had left for Biden. That in the first couple of weeks, because it takes into effect in 45 days, Biden has to make a real decision on Chinese policy. So thanks, Donald, for that one. I think the other beneficiary of this, and he could be a beneficiary of the Biden administration, is Elon Musk, who's now the world's richest man based on Tesla's share price movement over the last couple of days. So talking now to the second richest man in the world, Mr. Leyland.
Yeah, I think it's quite. Go on, Mark.
I was going to say you've got to take all of this into account, Chris, when you're positioning the true potential portfolios. So you've got to watch what's happening in the US. You've got to watch what's happening in China, and also you've got to take a view over Europe. And as Jeff said there, we had the Brexit agreement in between Christmas and New Year, and so far, guess what? We haven't run out of anything in the shops. But how are you taking that in account of that, Chris, when you come to look at the TP portfolios?
Yeah, it's a good question. I think for me, you've got to be really careful to avoid political noise and just try and, I know you sort of mentioned around Jeff cutting through a lot of the information around the US to give what he thought were the salient points. But that's exactly what you need to do within fund management. And I think with Brexit the general public, they're very, very passionate about it. And they're quite often focused on either one side of deal or no deal, if you like. But as a fund manager, you've got to cut through that, and you've got to think about how you're positioned for different outcomes as well. But I think if we just kind of pull back to Brexit, we do have a trade deal in place. And to me, that is a good thing. The reality is now businesses can plan again, and hopefully you'll start to see investment come back into the UK. And I actually think you have seen investment come into the UK overall, whether that be international fund managers who are looking to invest in the UK, We obviously have a global group of managers that we work with, and when we've spoken to them over the last couple of months, they've been talking about being interested in investing in the UK. They've actually gone ahead and invested in the UK. A couple of our managers, UBS, have added to the UK. Our in-house Growth Align team have added to the UK as well. So you are seeing more interest come into UK companies from fund managers. And I think the other side of that is, from an M&A perspective, you're actually seeing more interest coming into the UK as well. If we look at how asset prices have moved, and Jeff really touched on this, you've seen an increase in sterling compared to the US dollar, increase in sterling compared to the euro. If we look at what the FTSE's done this week, I think it's up just over 6%. It's up again today. When I last looked, it was up about 30 basis points. Again, that's not all to do with Brexit, and that's quite an important thing to say. But what you have is you have clarity and you have some sort of certainty there. The deal isn't the perfect deal that I don't think everyone wants, but the reality is you have a much higher level of certainty than you had pre-deal. And that means that you are seeing more interest come into the UK overall. So for us, how we're positioned, right now within the portfolios, we're positioned, I guess, fairly neutrally, maybe very slightly overweight the UK overall. From a currency perspective, what we always look to do here is to mitigate currency risk overall. So we have lots of different tools, such as hedging, currency options, different ways of thinking around currency overall to try and mitigate currency risk. But for me personally, I see it as an extra layer of certainty, and to me, that's a positive thing.
Yeah, I think so. And, Jeff, we've spoken in the past about the UK market being unloved. Now, there's a lot of the Brexit details still to be agreed. Yep. Financial services, for one, which is a huge benefit for the UK market, and London is a financial centre. But do you think this week we're seeing the start of a rotation back into the UK?
I think we're starting to see that on the margin. I think there's also an important thing for us to think about in terms of the structure of the UK market and the exposures that it has at a sector level, and what's been happening at a sector level within the large cap area of the UK market this week has definitely been a move in financials, energy and materials, and that ties back to something that George was discussing as well around infrastructure, but also just what's been happening in terms of global growth prospects potentially starting to pick up a little bit. And so those more economically sensitive areas of the economies starting to attract attention. And we know that energy stocks have been pretty much unloved. We know we've seen that over the course of this year, but they have been performing strongly as we've been thinking about a reflation trade. The other side of that is what's happening in materials. We know that iron ore's been strong, copper's been strong as well. That's feeding into the mining companies in the UK as well. And then financials, they typically like the yield curve to steepen, and that's what we've seen over the course of the week, and that again has been supportive. But looking back at just earlier in the week when we saw that big move up in the FTSE, and you're thinking about some of the large banks, the large materials moving 7 to 9% on the day. That's quite a significant move for those types of stocks. And on the margin, it maybe is suggesting that capital is being put to work. People are looking at the UK opportunity, just given, as we know, it just looks like an anomaly in terms of its performance over the past, not even 12 months, but over a much longer term relative to broader equity indices. So some of a rotation into those areas of the market that are key to the performance of the FTSE 100. I think this week it's also just worth noting the difference between how the FTSE 100 has performed versus the FTSE 250, the FTSE All Share. So it's very much been about the FTSE 100 this week, and tying that back into Brexit a little bit. We saw sterling move up to sort of peaking out at 136, 136.7. at the end of the year. And it hasn't really done anything over the course of this week. If not, it's come off a little bit. Sterling weakness again for the UK market, and particularly the large cap stocks, is a positive from an earnings translation perspective. So a number of trends all coming together there to put the FTSE. I think the FTSE 100 is probably one of the, if not the best, one of the best performing markets globally year to date.
Yeah, it's interesting. And reading one or two articles, you start hearing more about inflation. And reading your notes, Jeff, in the morning, we talk about European inflation. It's still negative. Looking at the component parts of the EU, the strength seems to be very much the powerhouse, which is Germany. And we've seen some stats coming out of there which would suggest that Germany's further ahead than the rest of the European countries.
Yeah, I think from a manufacturing and sort of services component as well, Germany has, it surprised me over the past couple of months how it's managed to maintain that resilience. And we've got some trade data out this morning, which again emphasizes the strength of the German economy. And I suppose also the linkages of the German economy into global manufacturing and trends also in Asia, and the link that I think China is now the second largest export market for Germany after the US. And that, I suppose, speaks to a couple of things. One, what we've seen in Asia over the past number of months is it's further along that recovery trend. And that is really benefiting in Germany within that Eurozone bloc today at the expense of the likes of Spain and Italy, who are much more dependent on the services side of their economy. And we all know that services has been a very, very difficult place to be. But we're still not seeing any sign of inflation coming through in the system. And that will be a thing that does potentially worry the ECB a little bit, and whether what we're seeing in terms of dollar weakness, euro strength, and the strength of the euro is actually negating any inflationary impulse coming into the system. We've also got to think about the sort of the base effects as well. We know that energy prices were so weak in the first half of 2020. When we move forward and drop into this year, and we start to see annual inflation numbers coming through, it won't be surprising to see that base effect coming through. And I think at that point in time, it's going to be very important for us as observers of this information and interpreters of it to really focus on core numbers and try and exclude the noise that comes through from energy, maybe even from food as well, and just really think about how inflation is playing through at the core level. And it's been, over the past week, we've seen the Caixin PMI data points out of China. We've seen the ISMs in the US, and both of those have spoke to rising inflationary pressure on input costs. And that has typically been a prelude to that feeding through into consumer price inflation. So quite an interesting dynamic on inflation, particularly if we overlay that with what central banks have been saying about their willingness to let inflation run above target. So a dynamic that will be interesting for the bond market and interesting for us to consider the implications that will have for portfolios and for asset prices as well.
Yeah, I want to come on to the bond market in a moment, Jeff, and I know George has got a point that he wants to make as well. George, you go ahead, please, and I'll come back and introduce the next question after you've spoken.
Yeah, of course. It was just, Jeff made the point there of the importance of looking beyond headline numbers. I think that was a really important theme all through 2020, looking beyond headline numbers, getting under the bonnet. And that is where the value of working so closely with our managers really came in. We've got access to managers' research suites, but we've also got access to different departments on the ground in different locations. So I think, 2021 and the years going ahead, will be no different, because you have got that disconnect in terms of how different sectors are performing, what different data points are telling us. They're influenced by the fact that, you know, lockdowns have been in place. So we have to look at data in a slightly different way. And I think that's why, you know, as an investment analyst, why working with our managers so closely can be really beneficial to us there.
Yeah, sure, George. And, you know, one of the points that I wanted to introduce, it lends itself to that, is that in the past, inflation, one of the main components has been energy costs. And over the last 12 months, we've seen oil prices move from the strange situation of negative oil prices, and albeit that was due to the market, etc. But this last week, we've seen almost an olive branch held out by Saudi Arabia to certainly OPEC, but also to their close neighbor Qatar. And it seemed a bit odd that the Saudis were allowing a cut in their production, which the Russians seem to have just picked on straight away, and they've been allowed to increase theirs. Should we read anything into this? Do you think there's going to be a shortage of oil, which will result in a price rise, which could see itself through to inflation, or is it not relevant at the moment?
I think it is relevant. I think it's an important thing for us to consider, because what we've had is we've traditionally had OPEC and then OPEC plus, and OPEC didn't include Russia, but bringing Russia into it is an important component. The fact that the Saudis were willing to compromise on their quota to allow Russia to pump a little bit more, but maintain that overall quota at around the 7 million barrels a day is really important, because it kind of indicates to me that the OPEC want to keep prices robust, and that robustness is important for their own domestic economies, particularly Saudi Arabia. Saudi Arabia probably needs the oil price above $50 a barrel on Brent to sustain itself, and that, I think, it speaks to increased cooperation, and also how they have moved over the past number of months to looking at setting the quota on a monthly basis and giving pretty good forward guidance to how that will be. So it was a bit of a surprise come Tuesday when we knew the meeting was Monday, and then, well, nothing had happened. So what's happening here? Is there a bit of a fight amongst them? But actually to come out with this agreement is I think an interesting indication of how OPEC are viewing pricing and how they're viewing production going forward. So tying it back to your point, Mark, it could be a thing that we do have to and do need to continue to think about, given the impact that it could have on inflation. And I suppose the Qatar situation is one where it's been in the background. It's been a real issue for that region for the past couple of years, and trying now to put that to bed to an extent is probably for the best for the region and the best for the functioning of inter-region trade, but also the discussions that will have to go around OPEC and OPEC plus going forward. So not something that I think many market participants at all were expecting to see Saudi cut, but I think that tells us all they want to support the price. They're willing to trade that off to support the price.
Yeah, good point, Jeff. I mentioned bond markets. Now, I want to spend a little bit of time talking about this. And Chris, you've used the bond markets well in 2020, particularly in the first quarter and into April, where they help support the portfolios. What do you look for, Chris, in one of the managers or in all of your managers when they're buying bonds?
Yeah, sure. So no, I think you're right. I think when what happened in kind of February and March time is obviously we saw the big equity market sell off, and the reason why we have multi-asset overall is because we want to offer some kind of protection in there. And what has happened during the sell-off, the equity market sell-off, is that we held bonds, but not just bonds. We held other products as well that actually made money during that equity market sell-off. So the kind of thesis behind multi-asset is to try and offer something to help clients navigate through every different type of asset price movement overall. So I think for me, if we look at the bond markets right now, I think the first thing to think about is actually we're in a pretty low yielding environment. You touched on this a little bit earlier on, but you've got sovereign bonds, so bonds issued by governments. Quite a lot of them are negative yielding right now. So what you're seeing is investors starting to look towards the risky areas of the bond market to try and find some yield. So whether that be investment grade or actually even the higher risk areas, high yield, emerging market debt. What we're seeing with our managers, I guess there's two things. I guess firstly, we've got what I believe are some genuinely really innovative managers. They're actually looking away from the bond markets to try and give that overall multi-asset protection, if you like that word. So they're looking at other things, such as maybe using currency, looking at different derivative trades, relative value trades, things going long one asset, short another. All of these are all different ways of thinking about something that offers a similar risk return characteristic to a bond if we were to see a sort of equity market sell off. But just within the bond markets themselves, what are they seeing right now? In general, I suppose the area that they are quite positive on is emerging market debt. Obviously, that's higher yielding. We've seen some of our managers look towards Asian high yield, the Chinese bond market as well. If you think of Asia and China, they are less focused around energy, therefore less focused around the oil price compared to, say, the US high yield market. And I think, other than that, I'd say our managers are not really looking towards the areas that are on negative yields. They tend to avoid, not completely avoid, but they tend to avoid looking within those areas overall. But I think there is opportunity in the bond market right now. But I'd say that opportunity is coming through more at the higher risk end than the lower risk end. And maybe from a sector perspective, what we did start to see, and this just isn't for the bond market, it's arguably for the equity market as well, but we're starting to see managers look towards those areas that are more geared towards the global economy reopening overall. So what we call the more cyclical areas. So you've seen that come through in quite a few of the trades from our sort of stock picking managers overall. And again, that's not just within bonds, but it's within equities as well. But I think for me, I kind of find this area of the market quite fascinating. And I find the alternatives to bonds really interesting as well. How managers are thinking about bonds in a low yield environment. And what is very good is because we have those innovative managers, they're actually looking at other ways of providing that protection overall.
Yeah. George, would you like to come in at this point? Because I know it's one of the areas that you follow closely with the funds that you're looking after.
Yeah, absolutely. I think, Chris, you made an interesting point there about not having to go into the areas of negative yielding assets and negative yielding bonds. And I think that comes down to the optionality which our managers have got. We're not required just to go in there and track an index. Our managers have got a number of different tools which they can use when certain areas of the market are offering a negative yield. You mentioned alternative products in there as well, which I've touched on with our advisors on a number of our webinars, which we run on a weekly basis, just demonstrating what they're to do. They're there to behave in a way which is different to how equity markets are behaving at any one point in time. And that's what we mean by diversification. It's not just building a portfolio of equities, bonds. It's also bringing in areas such as alternative assets, precious metals in there as well, thinking about how we work with currency. But you also mentioned relative value as well, which is maybe something which a number of our listeners today don't hear so much about, but it's about looking at the opportunities in one area relative to another and bringing that together in one single trade. So, there's a lot of options available for our managers. And Chris, you mentioned where they're looking for those opportunities. As you say, Asian high yield, looking at things like the residential mortgage-backed security market, looking at China bonds, direct China bonds, an area where our managers are seeing a better yield opportunity, but the bond issuance in there is seen as a bit more stable than it perhaps once was, given the changes which you've had in regulation in China to reduce leverage of companies and make that a more sustainable, more stable marketplace to be operating within. So there's been some really interesting moves, Mark. There was a lot of good returns made earlier in the year from the bond market, where you did see central banks start to step in and purchasing bonds, and there was that real demand there. But in the latter parts of the year, what we've been really pleased with within our managers is their innovation and how they've been looking outside of the traditional parts of the bond market to generate return for our investors.
Yeah. And Jeff, with interest rates being where they are, still at historic lows, is now a good time for either a corporate or a government to issue a bond?
I think most definitely. We've seen a lot of activity from refinancing. I think 2020 was probably one of the busiest years that we've ever seen for investment grade issuance, and that is quite an amazing point to bring up when we think basically markets effectively shut down to corporate issuance in March. The market wasn't functioning, and we saw, and to the points that Chris and George have been making, we saw demand for safe haven sovereigns come in and drive yields lower. But what we also saw at that point was spreads move out tremendously for high yield and an investment grade, and that created opportunities that our managers were able to step in and exploit, because these were offering much better risk-adjusted returns at that point in time. I think issuance of debt has been something that we've all observed over the past 12 months. It's been the way of governments to effectively deal with the COVID-19 pandemic. It's been required. They've had to issue more debt to be able to fund the various programs that are in place. If we think about here in the UK, I think we've probably borrowed something in the region of £285 billion in the gilt market over the course of this year to really try and give the economy a way through to the other side of COVID-19. And that has been facilitated because, well, one, the market's been willing to absorb it, but probably more importantly, the Bank of England have consistently expanded their quantitative easing program. Now, I don't think at one level they would thank any of us for saying that the Bank of England is financing the government's deficit, because they would be at pains to point out that's not what they're doing. But at the side of it, that's what they're doing. And we do have a dynamic in the UK where debt is greater than GDP. For the first time in a sort of a post-war period, which is quite a change. But the key thing there is, or two key things I want to make about there. Headlines that people throw out there, they put that out there as a negative. It's as if the UK is the only one in that position. That's not the case. It's a relative situation that we've got here. Other countries have done the exact same thing to issue debt to finance it. So it's not that we're unique. So that's one thing. And to your very point, Mark, rates are so low. Rates are at 0.1% here in the UK today. That's a very different dynamic than even at the financial crisis in 2008, 2009, when we last went through a similar period of debt issuance and quantitative easing support coming through. So the servicing cost of that debt is significantly lower today than it's ever been. And as we're touching on there, as Chris was mentioning, for a large part of sovereign bond markets, you're actually getting paid. You're paying the government to take your money, given that negative yield, which is just a very strange situation. But people want that safety.
What the Chancellor perhaps, and I know that we've got to be clear, there is a distinction between the Chancellor and the Bank of England. But if you had a big hole in your finances, would it be better to raise taxes across the whole of the population, or would you go to the capital markets and raise the money, particularly when interest rates are so low? The choice that somebody has to make.
it's a choice you have to make, and when you can finance it at that level, but also if you think about the duration at which you can finance that. So we've seen the issuance of debt has been longer term as well. So if you can lock in lower rates and lock them over an extended period of time, that is, well, it makes the situation much easier, because you're not running into a refinancing and rollover window at higher rates on a regular basis. So if you issue X amount of debt today at 0.1% for 50 years, well, that's a pretty good trade, you would think, given that over the medium term, you would expect, all else being equal, interest rates to increase at some point in that period of time. And then it's, well, somebody else's problem, isn't it, then, to roll it over at that point in time.
Absolutely. And government bonds don't have to have a set repayment date. Looking back in history, we've had war loans that have gone on and actually produced decent returns for investors, as well as helping government refinance when they needed to. So I would hope that this isn't ruled out when it comes to the day of reckoning, and we have to pay for what, as you said, 285 billion so far in support of the country as a result of the restrictions and the disruption that COVID has caused.
It's when you look just on that point, Mark, it's worth thinking about that in terms of the World War I bonds that the Treasury effectively bought back in 2014, 2015. They were issued on that same basis, with just a fixed rate of interest, but no scheduled repayment date. So investors in those got an income over that period of time, and the government wasn't at all concerned about having to roll them over at any point. But that was, I think they've been in existence from whatever 1916, 1917, all the way through to 2014, 2015, when they were last bought back. So there is precedent there for doing something like that. And could it be something that could be used? Well, possibly. You could make an interesting argument if you were to think about the ECB doing something like that with some of their program, the US doing something, and the UK doing something, and that coordinated effort between various different governments to think about that. It might be a sensible thing to actually do at this point in time, but it does require coordination. Maybe with Mr. Biden in the White House, we'll get much more of a the best way to think about it, a more open and more sort of broader view on international dynamics, that you could see more cooperation to deal with things, as opposed to a closed focus on, as Trump has had in just the US, which again would be a positive.
And as you said earlier in the podcast, Jeff, the 10-year yield on the States, on the Treasury over there, is just gone out to 109. And so that shows that anything, let's say, from, 1.5% to between 1.5% and 2% would be an attractive investment in the bond market at the moment, and a relatively cheap way to fund it with that sort of level of return. And there would be a market for that. People would buy it.
Yeah, very much so. And I think it speaks to just the innovation that we have to see. We've talked about the innovation of our managers, but maybe it's the innovation also on the other side of that, from a policy perspective and a monetary and a fiscal policy perspective, that we need to see some innovation there, and changes, maybe an acknowledgement that I think, as the Fed and to an extent the ECB may do as they go through their review period this year, but an acknowledgement that maybe some of the tools that we think work aren't as effective as getting growth up. So, and why do I say that? If we think about post-financial crisis, 2008, 2009, it's taken us probably pre-COVID to get back to the same level of economic growth. So 10 years of traditional economic policy, but we've not delivered on an improvement in growth over that period. People's income probably stagnated for a large part of that period as well. So is there a challenge to say that maybe some of those traditional tools that are in the central bank's toolkit are not functioning as well as they should? There was an interesting paper out just yesterday from the Bank of England, just looking at that, one of the MPC members just suggesting maybe we should be looking at other things. So maybe it is coming onto the agenda.
Yeah, sure. I mentioned earlier the news flow has continued, and we can't predict what's coming there. But what we do know is there'll be some data points released over the next week, say 2 weeks, that we need to keep an eye on. Anything that springs to mind from the three of you that you're going to watch out for with particular interest?
I think for me, and I'm pretty sure, Jeff, you may have mentioned this earlier, but just the US non-farm payrolls that are coming out later today. Obviously the key sort of thought from a lot of investors is, what will happen with the US stimulus package? How big will that be? Will it be the $600 check, obviously, or could it be the $2,000 check? How will that work? And with that, depending on how those employment numbers look, will obviously give some guidance or put some pressure around that US stimulus package overall. So I think for me, that's something that I'll be looking at today.
Good. Anything from you, George?
Yeah, so I think, Jeff touched on, the service data, the manufacturing data, which will be coming out, which will be given an expectation for how confidence has evolved. And we've got to take that with a pinch of salt, knowing that lockdowns have been sort of reimposed across the UK, many parts of Europe, and there's tighter restrictions across many states in the US, North Carolina, with curfews and so on. So, PMIs do continue to provide an important reading into the confidence, but we have to, in probably the next set of data, we need to be aware of the fact that lockdowns will be having an impact on that. However, the other side of that is we do still have, the increased rollout of the vaccination, which, if we look at the UK, we're ahead of in many of the European countries. I think, Chris, we were just talking yesterday about, vaccination rates in the UK approaching 1.5 million people. Compare that to regions such as France, still in the thousands. So I think in terms of the impact of vaccination, how that's going to start to roll out, vaccination participation and rollout, that will provide a very interesting data point, because we've got that target to move so quickly, because it has such an important impact in terms of how quickly we can get back to normalizing the activity levels, which has a whole greater impact on areas such as services. That's the reason why when you do see positive news around the vaccine, that's why you do get that positive kicker in the more economically sensitive parts of the market. That's why we saw that in, materials, energy, infrastructure here in the UK. So a few points I'll be looking out for, Mark. Yes, I'll be keeping an eye on what's happening within PMI, which is a reading on how supply chain managers are thinking about demand in the future. But it's also about the vaccination rate and how different countries are keeping to their target. I was listening to an interesting, it flashed up on my phone last night from one of our fund manager providers, UBS. It wasn't the UBS team we work with, but it was various specialists from their department, and they had a doctor on the panel, and he was talking about the challenges at this point are not so much in terms of the supply of the vaccination. It's very much in terms of the distribution. And he was talking about the various different ways in which countries are overcoming that, whether it's using pharmacies, as we are now starting to in the UK, as they are in the US with CVS now becoming part of that program, and really freeing up, frontline members of staff who are there to give the vaccination are already busy. So you need to think of new ways in which you can really improve the supply chain. So that's a long-winded way of saying, Mark, it will be the supply chain thoughts, but also the vaccination rates.
Yeah, and I think, George, it's essential that we cut through the red tape that's now slowing down the vaccine being delivered in the UK and administered. So vaccinations are vitally important.
I totally agree with that. I think for me, it's what are going to be the key drivers of sentiment, because we know sentiment is the thing that's really moved markets and will continue to move markets in the short term. It's very much around the noise that we will have in economic data. I don't think we can get away from that. It will be very messy. We saw that, and we can see that this week alone if we look at the the weekly payrolls number that we got yesterday in the States. We then compare that with the private sector ADP data that we got the day before, which looked to suggest that jobs had been lost in the private sector. What that means for the data point today, I'm not really sure. It's been a real messy period for data through this whole period, and it has challenged some of the assumptions that we as market participants have had about the leading effect of certain indicators. On the vaccine side of things, I would just also add that I think it's really important that it's about the percentage of the population that's getting it, and also what rhetoric we hear from those anti-vaccine people. We know that vaccines have been challenging for certain parts of the globe historically. If we think about MMR, etc. in the UK, there has been a real pushback from people around that. So we just really need to think about how that plans out and how we get to, I'd say, 50-60% of the population at least with a vaccine to really try and help with the overall level of herd immunity. So we've monitored a lot, and in our webinars we've used various different sites to help people think about the trajectory of infection rates, etc., and how we've tracked those. I think one of the things we're going to have to try and introduce into our webinars now is a vaccine tracker for the advisors to look at, to see what that is and where we are in terms of percentage of populations covered.
Yeah, the Spanish have certainly got a view, haven't they? They're going to keep a record of anybody who hasn't been vaccinated. So that's pretty clear.
And the other side of it, you're probably not going to be able to travel if you don't have a vaccine. So the vast majority of countries look to be requiring you to have a vaccine passport, effectively.
Yeah, it's interesting the way technology has handled this. I got an email yesterday from Newcastle Airport. I haven't travelled, I haven't flown since the end of February. But this email, they're trying their best to keep in touch. But they're now saying you can book your test before you fly. And all. At one time, it was weeks before you could be tested, weeks before the results came through. Now you can get it done at the airport before you fly. You just wonder what's going to happen if you don't pass, come through as being positive at the time. But it brings me on to what I wanted to close today's session with, Jeff. And, had it not been for COVID, you and I tomorrow would be boarding a plane to fly to Shanghai for UBS's Greater China Conference. It was a year ago that we did the same thing, but technology has moved on, and because we can't go to Shanghai, the conference is still taking place, but we're joining it remotely next week with different sessions. Now, whether or not we join them live, Jeff, bearing in mind the time difference between the UK and China, but it means that we can still get those insights into what's happening directly in China and the broader Asian markets, and extend that into the worldwide market. So I'm interested to see how this works next week. And thanks to UBS for inviting us again. And no doubt we'll share some more of those insights at a future podcast. But it also means that George and Chris can join as well. So they get the benefit of listening to the world-class speakers that are available to us online. And we'll bring that research and the viewpoints into the investment proposition that we have. So that's kind of where I would like to close things today, just short of asking everybody what they've got planned for the weekend. Answers of can't do much due to lockdown aren't allowed. So I'll start with you, George.
Can't do much because lockdown won't allow it. I don't know, Mark. I'm on a bit of a health kick and a bit of a keep fit regime at the minute, so it'll probably be something around that. But yeah, not a great deal, Mark. What can you say?
And regular viewers will know that Chris has got his fitness regime, which involves him getting up very early in the morning and going into London parks in darkness. Is that still going to continue, Chris?
It's continued this week, and I've ramped it up as well. So it's now 4 days a week, Tuesday, Wednesday, Thursday, Friday. For this weekend, tomorrow is a cheat day. So tomorrow is where I can eat and drink whatever I want. And I'm really, really looking forward to it. So it's going to be a takeaway curry. Sadly, no takeaway pints from the local pub because that's no longer allowed under lockdown.
That's very naughty, Chris. That's a naughty thing to do.
It was, and it's genuinely been one of the most disappointing things that have come through from this lockdown for me. So
I thought you were giving us a full meal plan there, Chris, and I thought we started with a takeaway curry in the morning.
So it's going to be a nice day tomorrow, and then just probably I was going to say a quiet weekend, which you didn't want me to say. Other than that, probably a nice walk with Moira, and just lots of relaxing.
Good. Jeff, in the Borders.
Yeah, I'm hope we've had some snow overnight, so I'm hoping that stays and I can get outside and play in that with the boys tomorrow. There's a decent hill here, so if there's a little covering, we'll get a sledge out and try and get down that tomorrow morning. And then the boys head back to school online school on Monday. So we've got a list of can you make the technology work for them to go through from the school, which for those that the team all know, my technology capabilities are not that good. So that'll prove a challenge on Sunday to go through all of that.
Oh, very good, very good. For me, I've got a trip to the opticians, and it's another thing that is allowed to open and stay open for eye tests, etc. So that's my fun. And looking out the window now, it is snowing, Jeff. So snowing in Northumberland. So hopefully the snow will stay with you up in Jedburgh. Gentlemen, thank you this morning. For everyone, I hope you've enjoyed it, the first podcast of 2020. I didn't say this at the start because it's the 8th of January, but I'll say it now in case anybody thinks I'm being rude. Very happy New Year to everybody, all TP clients, all advisors who are using True Potential, and to our viewers on the podcast. All the best for 2021. Rest assured that we're working as hard as ever, and we'll continue on our efforts to produce positive returns from the portfolios, come what may. Thank you, everyone, and we'll see you again. Bye-bye.
Thank you.
Thank you.
Thanks for watching. If you enjoyed this video, please leave a like and don't forget to subscribe to the True Potential YouTube channel. If you have any questions or requests for future videos, let us know in the comments.